Good morning. This is Larry McMillan with a stock market update on Monday, November 11th, Veterans Day. Be sure to thank a veteran today. So, the stock market broke out strongly to the upside after the election last week, and it's probably been the strongest reaction we've seen in a while. Crypto also was very positive. Some areas were negative. Solar energy, for example, I think is a little bit overdone on the downside. But in any case, our core bullish position is still intact as S&P is trading at new all-time highs. We would change that if S&P fell back below 5870 and closed there for a couple of days, but doesn't seem like that's going to happen anytime soon. The target for this move is a kind of nebulous one, but we're still looking at the +4 standard deviation modified Bollinger Band, which is up around 6080 now. So we haven't reached that target yet, and that buy signal that we got last August is still in place. It also is looking to reach that same target. Equity-only put-call ratios have kind of gone sideways now again. It looked like they were turning to sell signals right before the election. I wouldn't say the election produced a lot of call buying per se, but it does seem to have diminished put buying somewhat. So the ratios are kind of going sideways, and as a result, I'm not really seeing them giving any strong signal at all right now. If they were to begin to rise again, that would be a sell signal. If they fall back to below their October lows, that would be a buy signal. But right now, I'm not seeing anything there. Breadth, however, has been positive, and we do have breadth oscillators on buy signals. Sometimes, actually quite often, when the market's making new all-time highs, we like to see the breadth oscillators get very overbought. That's usually a sign that everybody's on the same page. That hasn't really happened right now. They're slightly overbought, but still, there are on buy signals. New highs versus new lows. For one day, new lows equaled new highs. That was short-lived, and new highs are off to the races again, commanding a strong daily lead over new lows, and so that indicator remains bullish. What changed a lot was the volatility complex. Of course, we knew options were expensive that were expiring right after the election. And once the election took place, no matter really what happened, those options weren't going to be as expensive. Since we moved to the upside, it was the put options that took a beating, but the implied volatility of call options dropped as well. So VIX itself has fallen back below 15, and as a result, stopped out that long-lived trend of VIX sell signal. There is a VIX spike peak buy signal in place, and that's still going to remain in place for another couple of weeks at least. And it would only be terminated if VIX were to sharply rise again over the near term. Again, that doesn't look like that's going to happen, but you can never tell for sure. The construct of volatility derivatives has moved back into a much more bullish posture as the term structures are sloping upwards. We're still seeing a little bit of expensiveness in the near term, which is causing the futures term structure to be just a little bit out of whack. But basically, the construct has returned to a bullish state as well. So we're coming up on some interesting periods here in terms of seasonal trends. After Thanksgiving, the seasonal trend is usually quite positive, and usually in 3 different steps. And then we move into January where there's a negative seasonal and then another positive seasonal. So we'll be covering all those in our newsletters, as well as these various market signals that I talk about. So I invite you to visit our website, take a look at those newsletters, and meanwhile, have a great week trading.